Hi, everyone. Good afternoon, or good morning, good evening. Thank you for joining us today, and welcome to the first in the series of 3 webinars on IFRS 18 presentation and disclosure in financial statements. IFRS 18 is a new IFRS accounting standard arising from the IASB's work on primary financial statements project. IFRS 18 was published on 9th April this year. My name is Aida Vatrenjak. I'm Technical Director here at the IASB, and IFRS 18 is a result of the work of myself and a large super team led by Ran Hasegawa. You will see most of our team members across the 3 webinars we have, and today I'm joined by 2, Nick Barlow. Hi, Nick.
Hello.
And Dennis Basel. Hi, Dennis. So before we get started with IFRS 18, let's just cover a couple of general points. So first, and very important, IFRS 18 and the accompanying materials are available on our website, and you can see the links on the slide. The questions today, please submit them as soon as you have them on the screen, and we will answer as many questions as we can at the end of our presentations. And please, as I said, as soon as you can, submit them so that we try find time to answer as many of them as we can. And finally, just a disclaimer that the views you hear today are those of 3 of us and not the views of the IASB or the IFRS Foundation. So with that introduction, let's move and introduce IFRS 18, our exciting new standard. So it's a new IFRS accounting standard, as we said, and it replaces a standard we're all very familiar with, IAS1 presentation of financial statements. And although some requirements in IAS1 have moved to IFRS 18 and other standards without change, IFRS 18 also introduces 3 new sets of requirements, all aimed at improving reporting of financial performance. And you see those 3 sets on the screens in front of you. The first one is aimed to create structure in the statement of profit or loss by requiring companies to present 2 new defined subtotals. This will provide a consistent and comprehensive starting point for investors' analysis and help investors compare performance between companies, in particular using operating profit subtotal, which will now be defined and therefore more comparable. Operating profit is something we often refer to as the star of the PFS project. This set of requirements will be the focus of today's webinar. The second set of requirements that you see here in the middle is that companies will be required to disclose information about some of their non-GAAP measures in the note to the financial statements. We call these management-defined performance measures, or MPMs. This will enable companies to complement information provided using the new structure of the statement of profit or loss with company-specific information about performance, and therefore give investors greater transparency about those measures. We will dive deeper into MPMs in the second set of webinars, which will be on 30th of May. And finally, the third set of requirements enhances guidance on grouping of information, something we refer to as aggregation and disaggregation in IFRS 18. This will help ensure that investors receive material information, making financial statements more understandable and useful. We will dive into this third set of requirements in the third set of webinars, which will be on 6th of June. So now with this introduction, I would like to hand over to my colleagues, Nick and Dennis, to introduce our topic today, categories and subtotals in the statement of profit or loss. Nick, do you mind if we start with you, and maybe if I can ask you to tell us about challenges investors have with reporting applying IAS1 today?
Of course. So investors have said that the structure and content of the statement of the profit and loss varies amongst companies, and even varies amongst companies within the same industry. As we know, IAS 1 today requires a company to present revenue and profit and loss, but it has no defined subtotals in between, and that's led to companies presenting varied subtotals calculated in different ways. So if we take, for example, operating profit, we know this is one of the most frequently used subtotals today, but until now, this hasn't been defined in IFRS accounting standards, resulting in companies applying different definitions to the same subtotal. This is a surprise to many investors who thought that operating profit was defined consistently and consistently reported. As we mentioned in our effects analysis that's published alongside IFRS 18, we did an analysis of the financial statements of a sample of 100 entities using IFRS accounting standards. And in their statements of profit or loss, we found similarities in the labels of the subtotals presented, but a high degree of diversity in how those subtotals were calculated. So if I come back to that example of operating profit, we noted that 61 of our 100 entities reported an operating profit subtotal, but there were at least 9 different definitions for what was included within that operating profit. This diversity makes it difficult for investors to analyze companies' financial performance, particularly when we're using that operating profit subtotal to assess margins or as a starting point for their analysis.
Thank you so much, Nick, and hopefully our viewers are already getting appreciation for why we called operating profit the star of the project. But Dennis, if I can turn to you now, and Nick has explained the issues today, and you maybe want to tell us about the specific requirements in IFRS 18 that will be addressing these issues.
Sure, thanks, Aida. So as Nick explained, I think the difficulty in comparing the financial performance was really the investor's concern, and our viewers can see that sort of on the left-hand side of the slide. So IFRS 18 tackles this difficulty mainly in 2 ways. Firstly, it introduces 3 main categories to provide a consistent structure of the statement of profit and loss, and these categories are really how investors typically would analyze the statement. Now, the 3 categories listed: operating, investing, and financing. Second of all, IFRS 18 introduces 2 new required subtotals that then enable investors in their analysis. And as you already mentioned, our star operating profit, and then also another subtotal, profit before financing and income tax. So today we're really going to take a more closer look at each of the categories listed on the slide, how they're defined, and the types of income and expenses that would be classified in each of them. But maybe before we delve into more detail, Nick, maybe could you chat us through an example of what this new structure might look like for most companies?
Sure. So here we have an example of a statement of profit or loss that might what might look like for a company applying IFRS 18, and this is what we refer to as a general corporate. We'll look a little bit later at the statements of profit or loss applying the requirements for some specific entities like banks and insurers a little later on. But in the illustration that we have here, we can see the subtotals that Dennis explained. So the operating profit and the profit before financing and income tax. So operating profit will give a complete picture of the company's operations. Investors said that operating profit is one of the most commonly used starting points for their analysis. Therefore, requiring a company to provide this subtotal will provide users with useful information, and that will make their analysis easier. Now, the profit before financing and income tax subtotal gives a picture of the financial performance before the financing activities. Now, again, many investors seek to analyze the company's performance independently of how that entity is financed, and so this subtotal facilitates that analysis. Now, on the right-hand side of the illustration, we can see the 3 main categories that Dennis referred to: the operating, investing, and financing categories. Now, those category headings won't be required under IFRS 18 here, and they've only been illustrated here for educational purposes. But a company could also present additional subtotals if those subtotals were necessary to providing a useful structured summary of the company's income and expenses. And we have an example of one such subtotal of gross profit here highlighted in gray.
Thank you so much, Nick. So as Dennis said, we have this general overview. So let's work through and go through each category and subtotal in turn. And as we do that, please encourage you, if any questions pop up, just put them in and we'll try to answer them at the end. So back to you, Dennis. Shall we start with our star and the operating category?
Excellent. Yeah, thanks. So I think Nikki already touched on it, but how IFRS 18 looks at the or defines, if I might say, the operating category. I want to start at the bottom of the slide. The main aim is really to provide a complete picture of the company's operations. And also the way that it's set up, that it can work for all business models. So that's really the end goal. But then how does it achieve that? How does it achieve that complete picture? I think first of all, the income and expenses that will be classified in the operating category are really all income and expenses from a company's operations, regardless of whether they are volatile or unusual in some way. So if we, for example, think of equipment that a company uses to produce its goods or services, that equipment might have depreciation, but also maybe impairments or reversals of impairments. All of those income and expenses, depreciation, impairments, and in reversals of impairments would all be classified in the operating category. And then almost secondly, the income and expenses classified in the operating category comes from an entity's main business activities, but it's not just limited to that. If we think, for example, about supporting activities that a company has that really goes alongside its operations, that those activities might not generate revenue by itself. The income and expenses from those supporting activities would also be classified in the operating category. And that's how IFRS 18 gives that complete picture of operations.
Thank you so much, Dennis. So two key takeaways for our viewers here on the operating category. Apart, you already know it's a star, right? One is it's a default category, and the second is it provides complete picture of company's operations. So that is operating category for now. Shall we look a little bit at the investing category? And maybe, Nick, if I can turn back to you and start by asking you to explain why this category was needed in the first place.
Sure. So again, we come back to investors' needs. We know investors often analyze returns from a company's investments separately from its operations. Now, the investing category enables investors to identify the returns on these types of investments separately from the operating profit. So the investing category facilitates that analysis.
Thanks, Nick. And I can see on the slide we have some examples of these investments. Do you want to maybe talk us through what types of investments did investors say they want to analyze separately?
Sure. So firstly, the types of investments are those that are in assets that are not related to the operating resources of the entity. So these would be things like an investment property that will generate returns such as rental income or potentially fair value gains or losses completely separately from the entity's main operations. So in IFRS 18, the standard refers to these as assets that generate a return individually and largely independently of the company's other resources. Another couple of examples of these would be debt or equity investments. These will typically generate interest and dividends on their own. So again, independent of the operations of the entity. Now, the objective here is not to classify the net returns on these investments in the investing category. So some expenses that might be associated with the assets will still be classified in the operating category.
Thank you so much, Nick. So, like with operating category, we also have a couple of key takeaways here with the investing. So one is that they are unrelated to other resources of the company. And also the objective is not to separately show returns on these investments. And therefore, you will not see all expenses related to these investments in the investing category. Now, let's look at investments in associate joint ventures and also unconsolidated subsidiaries, because we know from the work on the project that some companies consider at least some of these investments as related to their operations. And given what you just explained to us, can you tell us why did IASB decide to classify these in the investing category?
Yeah, that's right. That's a good question and an issue that the IASB received lots of feedback, as you mentioned. As you say, it's a bit of a tricky issue because some of these investments will generate returns separately from the operations, but we know others may be very closely linked to the operations. Now, the IASB debated a number of solutions for this issue, but ultimately the feedback from investors was that the income and expenses from equity accounted investments was one of the items they look at separately from operations, regardless of this relationship. Now, they said this is because the equity result does not have a revenue contribution, and it mixes the operating, investing, and financing income and expenses. And it's also a net of tax number. And all of these make it difficult for investors to analyze these types of income and expenses in the same way they look at operating profit. So the IASB decided that investing would be the most useful classification.
Thank you, Nick. So it sounds like this was a quite balanced decision by the IASB. And I suppose, we had similar challenges with cash and cash equivalents because there were different views as to whether they should be in the financing or investing categories. Do you want to maybe talk us through that as well?
Yeah, that's right. As you say, there are mixed views on how investors see cash. Some treat cash or excess cash, at least, as financing, because we know companies will use this to pay down dividends, repay debt, possibly buy back shares. At the same time, though, we know that companies will use at least some of its cash for operational purposes, and so include that as part of their working capital. Some stakeholders also pointed out that cash and cash equivalents would be an asset that generates a return individually and largely independently of the company's operations. So taking all of that feedback into account, the IASB decided that the income and expenses from these assets be classified in the investing category. Now, the added benefit of that is that it makes the structure simpler in the statement of profit or loss, in that the income and expenses from assets will be either the operating or the investing category, and income and expenses from liabilities will end up in the financing category.
Thanks so much, Nick. So it sounds like we have another key takeaway here, right? Investing category, assets, financing category, liabilities, generally liabilities, right? Dennis, we will come to that. And coming to you, shall we move on to the financing category and talk about classification decisions there, and also the subtotal of profit before financing and income taxes?
Oh, definitely. So maybe as a starting point, to point out, in the financing category, the income and expenses that are classified there arise from, I would almost want to say, two sets of liabilities. Firstly, on screen in blue, the income and expenses from liabilities that arise from transactions that involve only the raising of finance. We can delve into that in a bit more detail now. And then the other sort of types of liabilities would be interest expense and the effects of changes in interest rates from other liabilities, i.e. those that are not or that do not involve only the raising of finance.
So that gives us a little bit flavor around, what liabilities arise from transactions that involve only the raising of finance as opposed to other. But can you maybe talk a little bit more about distinction between the two, Dennis?
That's good. So I think the transactions that involve only the raising of finance, to put it in my own words, that would sort of be the pure financing liabilities that a company might have like bank loans. So IFRS 18 describes these liabilities as liabilities where the company receives financing in the form of maybe cash or its own equity instruments, and then at a later stage, the company will repay or exchange back, in other words, cash for its own equity shares. So it's really an exchange transaction that involves cash or a company's own equity. Also, then extinguishment of a financial liability would form part of the pure financing transactions. Distinguishing that then from the other liabilities. So the other liabilities, where I think it's important to point out, it's not all the income and expenses for the first sort of types of liabilities. It really focuses here on the interest income and expenses and the effect of changes in interest rates. And why is that? So if you, for example, think about on screen a liability like a lease liability, there the exchange is for a company to receive a right of use asset in exchange for the lease payment. So it's not a receipt of cash or its own financial or its own equity instruments and then later give the cash. It is receiving something else, like a right of use asset for the lease payments. Similar for defined benefit pension liabilities. The company receives employee services in exchange for then making payments towards an employee's pension, pension benefits. So I think what's important to note is that it is there's a mixture in the income and expenses for this other category between, income and expenses that are maybe more operating in nature versus maybe financing. So therefore, the IASB decided that the interest expense and effects of changes in interest rates from these other liabilities have to be classified in the financing category, because that is the financing component or element of these transactions, whereas the other parts might be classified in other categories. On that, I think it's also important maybe just to note for our viewers that for something like a defined benefit pension liability, yes, on the slide we talk about interest expense, but be mindful, I think those type of, the liability is a net liability. It can be a net pension liability or a net pension asset, and therefore it could be a net interest income or a net interest expense. And all of that, the interest elements would be classified in the financing category.
Thank you so much, Dennis. Explained something, relatively complex very clearly. And you just reminded me, talking about interest expense can be income. I think we had during the life of the project also a question with negative interest rates, and they could give rise to income that would also be classified in the same way, but noting that perhaps in the current environment that's not so common question anymore. But a very helpful explanation. And if I can maybe just summarize the key takeaways here is that, every liability has a financing component to it, and therefore there is some income and expense from every liability in this category, but we're distinguishing between two types where all that goes on is financing versus those such as leases and pensions where there is other things going on, and therefore it's inappropriate for all income and expenses that relate to it to be in the financing category. So thank you again very much. I'm sure there'll be questions coming on this, but we will take that at the end. So we have talked about the basics of the three categories and the classification. And at the very beginning, Nick, I think you mentioned already, we're going to talk about some specific cases of companies that invest in assets or provide financing to customers as their main business activity. So, for example, we usually talk about banks and insurers as examples of these situations. So do you want to talk through maybe how classification works for these types of companies?
Yeah, absolutely. So we know that classifying that income and expenses in the way that we've just discussed would prevent the types of entities you've just explained. So, for example, banks and insurers from presenting some of their key operating performance metrics within the operating category. And so that would impair comparability of that operating profit subtotal. So to address that, IFRS 18 includes requirements for these companies to classify specific income and expenses in the operating category that would otherwise have been categorized in the investing or financing categories. And so we do come on, as I promised, to an example of an entity that has these two types of activities as its main business activities. So providing financing to customers and investing in assets. And in this case, such as in the case of a typical retail bank, is what we see here. And all companies that provide financing to customers as a main business activity in the first instance will be required to classify the income and expenses from those pure financing liabilities that relate to that providing of financing to customers in the operating category. For the income and expenses from those liabilities that do not relate to providing financing to customers, the entity will have an accounting policy choice, whether to classify them in the operating category or within the financing category. So if a company can't distinguish between which liabilities relate to providing financing to customers and which do not, when it applies its accounting policy choice, it would result in it classifying all income and expenses from this type of liability in the operating category.
Thanks so much, Nick. So let's maybe talk about what we expect to happen as a result of this accounting policy choice. So what do we think will happen, and what does this mean for the profit before financing subtotal? Does that still make sense?
Yeah, so for most banks, we would expect that the accounting policy choice to classify all income and expenses from the pure financing liabilities in the operating category. And that's because they either relate to providing financing to customers or, given the nature of a bank's business of lending and borrowing, it might be challenging for them to separate those liabilities that are for the purpose of providing that financing to customers and that which isn't. So that's the case in the example that we have illustrated here. The company has made the accounting policy choice and classifies all of the income and expenses in the operating category. Now, I'd note that the accounting policy choice doesn't apply to those other liabilities that Dennis explained. So the interest expense and effective changes in interest rates on those other liabilities, such as the pension liability or the lease liabilities, will still be classified in the financing category. Now, because the entity makes that accounting policy choice and includes all of the income and expenses from its pure financing liabilities in operating profit, presenting a subtotal that is called profit before financing and income tax would be a bit misleading, because most of that income and expenses from its financing are included in the operating category. So in this case, an entity would not present that subtotal.
Thank you so much, Nick. So we have, again, some key takeaways here, right? If you provide financing to customers, you get to move income and expense relating to pure financing liabilities up, but you can't move these other liabilities that Dennis was talking about earlier. There's accounting policy choice to help with practicality of application, but it also has implications on presentation of the profit before financing subtotal. Now, this covers financing activities. What about the second specified main business activity we have in the IFRS 18 on investing in financial assets? Do you want to talk us through, Nick, again about classification when entity has this as a main business activity?
Yes, so similar to providing financing to customers, when the bank or any entity invests in financial assets, the income and expenses from those assets and from the cash and cash equivalents are classified in the operating category. However, all companies are required to still include the income and expenses from those associates and joint ventures accounted for using the equity method in the investing category.
Thank you so much, Nick. So this was an example of, a bank that has these two main business activities. But I think we also have another example of insurer. So do you want to talk us through how would this work for insurance company?
Yes, we do have an example here for an insurer, and it works in a similar way to that as the bank, but with some differences. So, as I just explained, for an insurer that invests in assets as the main business activity, again, the requirements work the same way. The income and expenses from those standalone investments and cash equivalents that other companies are required to classify in the investing category are instead classified in the operating category, along with its insurance finance expenses. And that allows the insurer to present their key operating performance metric of the net financial results in the operating category. So now, in this case, the insurer does not provide financing to customers as a main business activity. So those income and expenses that the bank classified in the operating category are still classified in the financing category by this insurer. And we still have the subtotal then for the profit before financing and income tax.
Thank you. Thank you so much. And I can see a number of questions have already come in on the topics we just presented. But before we start answering questions, if I can turn back to you, Dennis, and can we cover transition requirements in IFRS 18 and also maybe remind viewers of the various published materials we have on the website?
Definitely. So to give companies sufficient time to prepare, IFRS 18 is effective for periods beginning on or after 1 January 2027. Early application is permitted,
And I think it's important to note that IFRS 18 will be applied retrospectively and in interim financial statements. So you already mentioned we've got a host of beautiful documents for our viewers to enjoy. That's all available on our website. I think, as you can see on the list on the slide, we have the standard, the basis, and the illustrative examples, with supporting materials that include lovely flowcharts of how to think about some of the requirements. We have then one, I think maybe two to point out. I think we've heard initial feedback that our effects analysis are quite useful, especially helping our viewers with transition. And then it seems to be a favorite, but IFRS 18 on one page also seems to be useful. So our viewers can definitely go and have a look.
Indeed, Dennis, and this is not just us blowing our own trumpet, but we have evidence, right, of these things being useful already. So we are very glad to see that and to see that these materials can help you on the journey of implementation. So let's move on to answering questions, and we had very many questions that have come in as we were speaking. As I said, we will try to answer as many as we can, but let's see how successful we will be in doing that. So to start off, we have some quite popular questions, and starting with classification in relation to foreign exchange gains and losses, and that is one we have discussed quite a bit on the project. So Nick, do you want to talk us through maybe what IFRS 18 says on Forex classification?
Yes, definitely. So there are some specific requirements in IFRS 18 for foreign exchange. As many viewers will probably have been wondering as we talked through, we have assets, income and expenses from assets that can be classified in operating or investing. We have income and expenses on liabilities that will be in the financing category, but foreign exchange could arise from any of these. So there was an obvious question there about, so what do we do with this classification? And so the guidance in IFRS 18 answers this by saying those foreign exchange differences that arise on those assets or liabilities are classified in the same category as any other income and expenses that are coming from those assets or liabilities. Now, that works conceptually, but some entities told us that might be costly to implement. Their systems may not necessarily track the source of that FX. For example, if they're managing the risks on those in a central treasury function, for example. And so there's a cost relief within the standard for if it would result in undue cost or effort to classify in each of those categories, as I explained, then an entity can classify instead all of the foreign exchange gains or losses in the operating category. Along with that, we often get asked the question, well, what about if I'm working in a hyperinflationary economy and I have this gain or loss on the net monetary position that often comes as a single line item. And so the standard also addresses that and says specifically that if the company does not present that gain or loss on net monetary position with the associated income and expenses in each category, it classifies that gain or loss also in the operating category.
Thank you, Nick. And indeed, we do get asked this, don't we? And also another related question, maybe useful just to cover it off now, is classification of income and expenses from derivatives. Do you want to maybe talk through that as well?
Yeah, certainly. That's sort of the question that leads on when we talk about FX, because typically entities manage their FX and they do that a lot of times with derivatives. And so again, the standard includes some specific guidance around classifying income and expenses on derivatives, which, similar to FX, could arise in any of the categories. So because we know that derivatives are often used for risk management, there's requirements that if that derivative is used to manage a particular risk that it's identified, then the gains or losses on that derivative would be classified in the same category as the income and expenses arising from that risk that it's managing. And so that allows the entity to classify those income and expenses in the same place as the risk that it's managed. Now, there's sort of two situations where that might happen. An entity might be using hedge accounting under IFRS 9. Given that there's a designated hedging relationship, that relationship is quite obvious and easy to identify. And so the income and expenses on the derivative would follow the risk that's being managed, and that's quite easy to identify, as I say. In the case where an entity is not designating a hedge, it would still be able to use this risk management concept for those which we may term as an economic hedge. So again, the entity would identify what risk that particular derivative was managing, and the income and expenses would go in the same category as whatever that item generating that risk is. Now, in this case, because we don't have that same clear link as we do in hedge accounting, there is a similar cost exemption here if it would lead to undue cost or effort to identify that relationship. And we might see this in similar situations, as I explained in FX, where if these things are being managed centrally, that gain or loss or those income expenses would be classified in the operating category. And I think it's always important to give the proviso here, or the caveat, that this is presentation. None of this changes the presentation or the measurement. It's simply a classification. So an entity is not applying hedge accounting in this case, but it is able to classify income and expenses that are related to each other in the same category.
Thank you. Please finish.
No, I wanted to just say one other sort of additional bit is, because we talked about for banks, for example, or for entities that classify income and expenses, some income and expenses within the operating category, when a derivative is related to one of those items, one of those financing items that we talked about as pure financing, that related gains or losses on those derivatives would also be eligible to be moved into the operating category. And we also know that some derivatives are sort of a part of the financing and related directly to that financing, and not necessarily for risk purposes. And so again, there's requirements there that if that's the case, the gains or losses would also be in the financing category.
Yeah, thank you, Nick, for reminding me of those aspects. As you can see, there's quite a lot we say here, and but please, no need to panic if you don't have these transactions. There's nothing you need to do, but if you have them, we hope that this guidance will be quite helpful. And thank you, Nick, for reminding our viewers that IFRS 18 does not change recognition and measurement, and sometimes it's helpful we make reference to things like the hedge accounting requirements, but even that doesn't drive classification per se. There are other things that companies can consider as well, but important takeaway is this is about where items are classified and presented, and it's not about what is measured and how much, although there is maybe a little bit transitional choices in relation to some of the measurement choices vis-a-vis associate in JVs, which brings me to the next set of questions. And if I can give Nick a little bit break and turn to you, Dennis, and this is another, let's say, popular area for questions about, associate and JVs, and especially, as we said in presentation, IASB acknowledges that there are companies for whom at least some associate and JVs are closely related to their operations. And the question is, so if I'm one of those companies, what can I do applying IFRS 18 to communicate this to my investors?
Thank you. That is a very good question. I think it might be helpful. I'm going to just scroll back to our example profit or loss that I can maybe explain things a bit better. So I think, just to be clear again, how Nick explained is that income and expenses from associates and joint ventures accounted for using the equity method have to be classified in the investing category. I think Nick explained sort of the reasons for why the IASB made that decision. But how does IFRS 18 help then, to your question or to the viewers' questions, Aida, in terms of if these investments are closely linked to their operations? So firstly, IFRS 18 does not mandate the, where in the investing category the share of profit or loss of associate and joint venture needs to be presented. So, for example, on screen, our viewers would see that line item is here shown right underneath, the operating profit. That's the required subtotal. So what a company would be able to do, if it provides a useful structured summary, and I guess that concept we'll cover in a future webinar, so keep watching. They could add a subtotal below the line share of profit or loss of associate and joint venture. And in a way then show the performance of of that associate and joint ventures together with its operating profit as a subtotal. And how IFRS 18 further or helps this is that it excludes this subtotal from being what we call a management defined performance measure. So therefore, the disclosures, again, we'll talk about in a upcoming webinar on management defined performance measures. A company would not need to provide those disclosures for that subtotal. Yeah, there was something I just wanted to also mention. Sorry, Aida, on these investments. I think it's maybe just important to emphasize again, it's the investments measured or accounted for using the equity method. Some companies might account for these investments under under another method, like measuring them at fair value. Now, when the investments are measured at fair value, those assets are then subject to the main business activities requirements we spoke about. So to summarize quickly, if the company invests in these investments in associates and joint ventures as a main business activity, the income and expenses then being the fair value gains and losses would then go up into the operating category. So I just wanted to make that distinction that, fair value measurement is a little bit different to the equity accounted method.
Thank you so much.
Let me go back to the question slide.
Yeah, let's do that. And Dennis, you explained this so nicely. And given that you mentioned main business activity, I will stay with you if that's okay, and cover a question that has come in. And our viewers has asked, how would requirements work for companies that have multiple main business activities?
Okay, I think maybe taking a step back from that question, it's maybe important to note that IFRS 18 only requires a company to assess whether it has one of the two or both of the two specified main business activities in the standard, and that being either investing in assets or providing financing to customers. So those two main business activities, a company would need to make an assessment, applying judgment, considering evidence, and it's those two that are important because they then trigger some of the accounting policies and where income and expenses are classified, as Nick explained. So for a company that has maybe both investing in assets and providing financing to customers as a main business activity, it would provide the requirements to both of those activities. But if we think about another company that has got, it's got construction and it's got a retail business, I don't know, that's not a main business activity that IFRS 18 will require companies to identify and apply judgment to. I hope that helps.
Yeah, thanks, Dennis, indeed. And I promise I will let you go have a short break very quickly, but just a quick one that has come in, and I thought maybe just cover it. And it's about, is this assessment always the same? So say company that has consolidated and separate financial statements. Could you want to talk us through that?
Thank you. Yeah, sorry, a good question. So this assessment is done sort of separately for the consolidated and for separate financial statements. So a company in a group situation might find that in separate financial statements, the outcome of the assessment of main business activities is different to what it would be at a consolidated level. Thank you. That's a very good question.
Thank you, Dennis. I think you've earned a little bit break now, and over to you, Nick. So there are a couple of questions that come in relating to the gross profit subtotal, and as we explained in the presentation, it's not a required subtotal, but it's a subtotal that can be used. So what was the basis for that? Because this requirement presumably means that not everyone will therefore present gross profit subtotal. Nick?
Sure. So I think it's important I would relate this back to the similar requirement that we have today in IAS 1 to present additional subtotals when they're relevant to an understanding. Now, we've used, as Dennis said, not to give away too much. We have this concept of a useful structured summary, which I think will result in very similar outcomes to those additional subtotals. So when an entity determines it would presenting such a subtotal would give a useful structured summary of income and expenses. It would provide that. So again, very similar to what you would do under IAS 1 today, although slightly different terminology and some slightly different guidance around that. Gross profit in particular, I think we would expect to see often, and many companies we know presented, and nothing in IFRS 18 would stop companies doing that. I think similar to what Dennis had explained with that subtotal for associates and joint ventures and the operating profit. Gross profit is one of those subtotals that, because it's so well known and so well used, the IASB said that's not going to be one of the management defined performance measures, which again, another set of requirements that we'll talk about in a future webinar, but there are some additional disclosure requirements for those types of measures. Gross profit is specifically excluded from those because of that, because it's used so often and everyone sort of knows what it means.
Thank you, Nick. And, we are, as you said, giving a little bit of preview of some of the discussion in the third webinar where we will cover useful structured summary in more detail. But there was another question. I think it may be useful to cover it today without giving away too much, so to speak. And I think this relates to item we presented on the slide you were showing us just a minute ago, Dennis. And the viewer asked the question why we show income and expenses and lease liabilities together with income and expenses from borrowings when they are different types of liabilities, as per classification definition explanation. So Nick, do you want to maybe just talk through this as well?
Sure. There's probably two elements to this, and if this wasn't what you had in mind, Aida, you can maybe add to this. But I think that one element of this, it goes back to that useful structured summary that I talked about, and so having those as two separate line items within the statement of profit or loss wouldn't be a specific requirement. And then if it provided again that useful structured summary, could aggregate those together and have a single line item in that financing category to keep them together. I think the other element is just goes to what is trying to be portrayed in the slide is to show that difference between the two different types of liabilities that are specified in IFRS 18. And so we have those that are purely for financing, and so those are all of the income and expenses go there. With these other types of liabilities, there's interest and those changes in interest rates that we want to capture, because as Dennis explained, that's kind of the financing component of it. But those types of liabilities are separate because there's another element to those. And so those changes, those types of the initial transaction, for example, those types of income and expenses, we want to go in whatever that underlying transaction was. So that likely operating, could be investing, but separate from financing. So that's why we have the distinction between the two types, those that are all about financing and those that have only an element of financing.
Thank you, Nick. And I think that's kind of what I was thinking as well. So one is the definitions to help you decide what to classify, but the fact that you follow those definitions doesn't mean all of those should be separate line items presented, and that depends on your assessment of useful structured summary, which we have now mentioned quite a few times, but we promise we will come back and explain better in the third webinar. And Nick, you're doing such a wonderful job as well, so I will not let you go just yet. So there was a question about discontinued operations and assets held for sale, so our IFRS 5. So the question is, what will happen with these in IFRS 18?
Sure. So we talked about in the presentation, or at least Dennis did, that we had three main categories, but there are two other categories that are defined in IFRS 18, and one of those is discontinued operations. I won't make you wait. The other one is tax. But so any income and expenses that would be that would be normally classified in discontinued operations applying IFRS 5 will go into that discontinued operations category. Now, there is some guidance in IFRS 18 also around when something changes categories. And so if something moves us to held for sale, if it comes from a single category, that it would continue to any gains or losses on that change would be classified in that original classification. So if it was an operating asset, for example, and it was moved to held for sale, and there was some gain or loss recognized in that movement, that would remain in the operating category, and any income and expenses ongoing would continue to be in the operating category until it is removed. The one complication to this is, in some cases, that held for sale item could be a combination of assets and liabilities. Those assets might come from different categories. So in the case that that item mixes items from different categories, any gains or losses would go into the operating category. Again, consistent with the definition as the default category.
Thank you so much, Nick. You definitely earned your little break now with this explanation. And, you know, as you said, we have provided this guidance because these scenarios arise, as we have heard from stakeholders. But of course, if this doesn't apply to your particular company, you don't have to worry about what may seem like, you know, a little bit complicated paragraphs. So I know, Dennis, this means back to you. So we had a couple of questions on the investing category, and if we can maybe cover them. One is, I think one of our viewers is from a property company, and they said, we are a property company and we do both construction activities, and then we also have our investment properties that we hold. So their question is, so are the rentals and now investment properties going to be classified in the investing category, or what will happen? Do you want to cover that first? Yeah.
Yeah, no, thank you. I think a very good question. So the assets that I think Nick also mentioned that would for the income and expenses would be classified in the investing category, and I think you mentioned investment property. Those assets are still subject to an assessment of an entity's main business activities. If our viewers recall, as we said previously in another Q&A, that, you know, one of the two main business activities that IFRS 18 requires you to identify is whether you invest in assets as a main business activity. So if this company invests in these investment properties as a main business activity, the income and expenses would go into the operating category.
Thank you. Thank you very much, Dennis. And we have another question on the investing category, and this touches back to what, Nick, I think you said at the very beginning. The objective of investing is not to have complete return from these investments, and therefore not all expenses from these investments would be in the investing category. So our viewer is asking, what expenses do get to be classified in the investing category in relation to these? So Dennis, do you mind covering this as well?
Yes, no, thank you. So the IASB decided to limit the income and expenses that are classified in the investing category to the income that is generated by these assets, and then the income and expenses and also the incremental expenses that really link to the acquisition and then the disposal of the assets. So there was a concern that if other incremental expenses, so in other words, expenses that the company would have incurred had it not had the investment throughout the life, might require complex and costly allocation processes. So that sort of the costs over the life of the asset would not be, the expenses would not be classified in the investing category. That would go by default into the operating category. I hope that makes sense to our viewers. And please add some more, Ada.
It brings memories of us working on that paper, right? And it's again a balanced decision by the IASB to be pragmatic and practical and not impose undue cost on the companies in these classifications. But thank you very much, and fantastic work on that paper, by the way. Nick, I hope you had enough of the break, because we have a couple of more questions. We have about 8 minutes to go, and there's a few more questions coming. So let's just see how many we can work through. And I think coming back, although I kind of promise we're not going to go back to useful structured summary, but questions keep coming back. I feel it's unavoidable to talk about it when we talk about structure and categories. And the question is, when is a company required to present additional subtotals other than those specifically required in IFRS 18?
Yes, and so that comes back again to useful structured summary, as you've said. So it is a requirement. It's very similar to the question that we had earlier that I explained about that useful structured summary is very similar to what we have in IAS 1 today around providing relevant information. And so that it's changed. I think the big change is, requires maybe a little bit of an explanation that IFRS 18 defines the roles of the primary financial statements and the notes, and it says that the role of the primary financial statements is to provide this useful structured summary, a summary of that's useful to identify the income, expenses, assets, liabilities, equity, and cash flow, but also useful for making comparisons between entities and over time, and also for identifying areas where investors may want to look for further information in the notes. And so that's what really drives. If it meets those criteria, it's something that should be presented within or is required to be presented in the statement of profit or loss. And as I say, I think it's very, very similar to what we have, as it would provide relevant information today. We wouldn't expect significantly different judgments, although people will have to work through that guidance and think about whether that a particular subtotal meets that or not.
Thank you, Nick. And there is more to say about this, right? Which we will do in a few weeks' time. Another related question, if I can stay with you, and this is about interaction with IFRS 8, our standard and segment reporting, and our viewer is asking, will the same requirements for subtotals and categories apply to segment reporting?
So not necessarily, well, not directly. So there's no requirements that have that, and IFRS 8 hasn't changed. So so there's no requirement to replicate what is in the statement of profit or loss by default or by any specific requirement. Now, because IFRS 8 hasn't changed, if those same subtotals are what are being reported to the CODM, they may be picked up by that mechanism, but there is no specific requirement to say that needs to be replicated. It's still the guidance in IFRS 8 applies.
Exactly. Thank you very much for that explanation, Nick. And Dennis, coming back to you, I've just seen a question come in that we receive quite often, and this is about relationship between classification in the statement of profit or loss and the statement of cash flows in IAS 7. So the viewer is asking, why did IASB not fully align classification between the two statements? Can you talk us through that?
Maybe just a bit of a seller that the IASB is embarking very soon on its project for the statement of cash flow, of course. But then I think the differences in the classification between what IFRS 18 requires and what our standard on the statement of cash flow requires really talks to the different objectives I think that these two statements have. And I think really speaking to the investor needs with these two statements. So maybe if we think about an example, the objective of, I think, the investing category in the statement of cash flow is really to identify a company's investment in long-term assets that will generate a future return. And that would include things like property, plant, and equipment. However, in the statement of profit or loss, the income and expenses from or classified in the investing category, the income and expenses for, I want to say, from assets used in the operations of an entity, that would actually go into the operating category. So it's just got a different objective in mind and different information points about maybe the same asset.
Thank you, Dennis. And that's, as you said, it might come back for discussion. It really depends on the decisions IASB makes on the scope of its forthcoming work on the statement of cash flows. So there may be more work in this area, but in the PFS project, we were very much driven by user needs and what would be useful for them to be classified where. And the objective of PFS project was not comprehensive review of statement of cash flows. So even though there were some amendments to IAS 7, that was on relatively modest scale compared to the needs our stakeholders have expressed vis-a-vis that statement, and hence the new project coming up. But I'm afraid that was probably the last question we had time for. We have still a couple of questions here in the queue, and my apologies to viewers for not having time to come to those today, but I'm sure there'll be other opportunities as well. Before we close, I just want to come back to this. Thank you, Dennis, to this wonderful slide that showcase all the materials. So it's not just the paragraphs of the requirements in IFRS 18, but it's also illustrative examples, flow charts, help you navigate to the requirements, effects analysis showing, who and how we expect to be affected, which can really be useful roadmap to your implementation, as well as project summary with high-level overview and a feedback statement that shows how IASB responded to the feedback we received in the exposure draft in finalizing the standard. So I really hope you find all of these materials useful as you embark on your implementation projects. And with that, I only have thanks to give. So first, our wonderful team. Thank you, Nick and Dennis, joining us today. And our team in the background who has done lots of hard work to make this and future webinars happen. And huge thanks to our viewers. Thank you for joining us today. Thank you for your questions, and thank you for all the effort you're going to put in, I'm sure, wonderful implementation of IFRS 18. And hope to see you all at the next webinar on MPMs on 30th May. With that, I wish you all the best and goodbye.
Bye.